Welcome back to Investing Talk Podcast. Today, we're taking an in-depth look at Ondas Holdings. It's a company really operating at this fascinating intersection of private wireless networks and autonomous drone systems. Our mission today is to, unpack their recent financial reports, dissect some of the big market moves we've seen, and try to piece together what it all could mean for where the company is headed. This is quite a story, rapid growth, innovation, but also some, let's say, notable financial hurdles. Before we jump in, if you're finding these explorations helpful, please take a moment to subscribe, hit that like button, maybe leave a comment, and consider buying us a coffee to support the show. Your engagement really helps us bring you more of this kind of analysis. Okay, so let's kick things off by getting a handle on what Ondas actually does. It's a tech company, essentially, with two main units. First up, there's Ondas Networks. They specialize in secure, scalable, private wireless networks. Think critical infrastructure sectors, utilities, transportation, especially rail.
Right, these aren't just your standard networks. They're built for really high reliability, high security, things that, say, a power grid or a railway absolutely needs.
Exactly, foundational stuff.
Yeah.
Then the second part is Ondas Autonomous Systems. This is focused on AI-powered autonomous drone platforms.
Things like aerial security, detailed industrial inspections. We're talking about those advanced drone-in-a-box solutions.
So not just flying cameras. These are systems designed to deploy, run missions, and return, all pretty much on their own.
Which is a huge area of interest, obviously, for automation and security.
Now let's get to the numbers that really grabbed attention. Q1 2025. Ondas reported revenue of $4.2 million. Now, $4.2 million? Okay, but here's the kicker. That's an increase of over 500% year over year, compared to Q1 2024's $0.6 million.
Wow, yeah, that kind of jump, it's significant. It really signals they're gaining traction.
Where did that come from? Apparently, it's largely from starting to deliver their Iron Drone and Optimus systems. These were under new contracts they locked down late last year and early this year.
That makes sense. It suggests they're moving from, maybe pilot programs or smaller deals into more substantial deployments. But it's also worth noting that kind of rapid growth, while impressive, still positions Ondas as more of a challenger, an innovator, right? Not quite an industry leader yet compared to the established players. Their overall scale is still, relatively speaking, quite small.
Good point. And adding to that picture, their backlog increased to $16.8 million. That seems like strong momentum for future quarters.
It certainly looks positive on the surface. A growing backlog indicates market acceptance, future demand. But it also really shines a spotlight on execution risk, doesn't it?
How so?
Well, they need to convert those orders efficiently, turn that backlog into actual revenue, and critically into profit down the line. It's one thing to get the orders, another to deliver at scale profitably.
Okay, let's dig into that profitability aspect, because while the revenue growth is, frankly, astonishing, the other side of the financial coin tells a different story. Ondas's net loss actually widened in Q1 2025. It went up to $14.1 million from $9.9 million the year before. So what does this continued loss really imply? For things like earnings per share, sure, but also for their overall financial health.
Well, this kind of profile, it's pretty typical for emerging tech companies, these disruptors. When you have persistent net losses, metrics like the price-to-earnings ratio, you can't even calculate it meaningfully. There are no earnings.
No earning.
And return on equity is likely negative. Free cash flow, that's been negative for years. It's just characterized by these ongoing operating losses and increased cash burn.
That phrase, burning through cash, we hear it a lot with tech startups. What does it mean practically for a company like Ondas, especially as they're investing heavily to scale up?
It means exactly what it sounds like. They're spending more cash than they're bringing in from their operations. They're essentially funding growth, R&D, building out capacity before they reach profitability. It's an investment phase.
So it's necessary for growth, but risky.
It is. The key question becomes their cash runway. How long can they sustain this burn before needing more capital or turning profitable? On a slightly more positive note, though, recent reports did mention their convertible debt has been reduced significantly.
Okay.
So that does help their balance sheet somewhat. Less debt burden, less potential future dilution from conversions. It shows they are actively managing their finances, even amidst the losses.
Now let's pivot to some recent events impacting the stock. This gets really interesting. On June 11th, 2025, Ondas announced they closed a big public offering, $46 million, underwritten. And they mentioned the underwriters exercised the full over-allotment option. It involved issuing 27.2 million new shares, plus these things called pre-funded warrants. Net proceeds were about $42.8 million. So why such a large capital raise? What's the strategy there?
Well, There's a kind of dual impact here, you see. The money raised, about $42.8 million net, is stated for general corporate purposes, funding capital expenditures, working capital, basically, fueling the growth in operations we've been talking about. For a company scaling up like this, that cash is vital.
Okay. Provides flexibility.
Absolutely. But the way they raised it, by issuing 27.2 million new shares, well, that's significant dilution for existing shareholders.
Dilution meaning their slice of the pie gets smaller.
Precisely. More shares outstanding means each existing share represents a smaller percentage of the company. And those pre-funded warrants add potential future dilution when they're eventually exercised to buy shares.
So it puts downward pressure on the stock price.
Typically, yes. Increased supply of shares tends to do that. The overallotment just means demand was strong enough for the underwriters to sell even more shares than initially planned, adding to that supply.
Okay, so dilution is one factor. But right around the same time, Ondas also announced it had regained full compliance with Nasdaq listing requirements. That sounds positive?
Oh, it is. Regaining Nasdaq compliance is definitely viewed very positively by the market.
Why is that so important?
It removes the immediate threat of being delisted from the exchange, which can be, frankly, catastrophic for a stock's liquidity and investor confidence. Staying listed keeps them accessible to a wider range of investors, including institutions that might have rules against holding non-compliant stocks. So it helps stabilize sentiment.
So you've got this tension. The good news of Nasdaq compliance weighed against the negative impact of the share dilution from the offering.
Exactly that. The market is constantly weighing these conflicting signals, the need for cash and regained stability versus the cost to existing shareholders.
And we saw some of that play out, didn't we? The stock dropped around 8% after the Q1 earnings came out, despite that huge 500% year-over-year revenue growth number. Why the disconnect? Strong growth, but the stock sells off.
It often boils down to expectations versus reality. Even with that 500% growth, Ondas apparently missed the consensus estimates from analysts, both on the revenue top line and the earnings bottom line.
The analysts' targets.
Right. Markets react badly to misses. Combine that miss with the widening net losses we discussed, the ongoing cash burn, and then the news of the dilutive stock offering needed to fund operations.
It paints a picture of needing cash and not quite hitting the expected milestones.
Pretty much. Investors get nervous about the path to profitability and the capital required to get there, leading to a sell-off. It shows how closely the market watches not just growth, but sustainable growth and funding needs.
Okay, so zooming out a bit, how does Ondas stack up against competitors in these, cutting-edge sectors? Are they going head-to-head with bigger, more established companies?
Yes, definitely. In industrial wireless, you've got big players. Even established telecom equipment providers like Nokia or Ericsson have enterprise arms, plus more specialized firms. And in the drone space, you're looking at companies like AeroVironment, potentially divisions within larger defense contractors, too.
And how does Ondas compare?
Well, most of those competitors are much larger, often profitable, with more stable, diverse revenue streams. Ondas is more of the focused innovator right now. Their edge in the networks division seems to be this proprietary software-defined radio, or SDR technology. Software-defined radio. It gives them flexibility, allows them to adapt their networks quickly for very specific critical infrastructure needs. That's a key differentiator. And on the drone side, they seem to have an early lead in these fully autonomous, AI-driven drone-in-a-box of systems. It's a specific niche, but growing fast.
So innovative tech, but lacking the scale and financial stability of the giants.
That's a fair summary. They're the challenger, the disruptor, not the incumbent leader yet.
Understood.
Looking ahead then, what major industry trends are really helping Ondas? What tailwinds are pushing their business forward? There are definitely a few key ones. First, the demand for autonomous drones is clearly rising, not just for inspections, but heavily in security and defense now. Second, there's this big global push to modernize critical infrastructure. Power grids, railways, their private networks fit right into that need for better, more secure systems.
And they're expanding geographically too, right?
Yes, they've announced contracts in Europe, the Middle East. That suggests global demand for what they offer, which is a good sign. But there are risks tied to this growth, naturally.
Such as?
Well, the high R&D spending needed to stay ahead technologically is one, and then there are the regulatory hurdles, especially for drones, which can vary a lot place to place. And fundamentally, the big question remains, can they scale effectively and execute on converting that backlog into profitable revenue? That's the core challenge.
So for you, the listener, maybe watching this company or just interested in these sectors, What should you be really keeping an eye on in future reports? What are the key signals?
I'd look for clear signs of improvement in their gross margins. Is the revenue they are generating becoming more profitable? And watch the cash flow. Is the cash burn slowing down? Are they moving towards positive cash flow from operations? That would be a huge milestone.
Beyond the numbers.
Pay attention to announcements about major customer wins, especially large-scale deployments or follow-on orders from existing customers. That shows the technology isn't just promising, it's proving itself commercially and scaling successfully. Those operational wins are crucial.
So wrapping this up, what does this all mean for you, the learner, looking at these innovative but complex areas?
Ondas Holdings really presents this fascinating mix. It's a high-growth story, clearly is showing impressive sales momentum, but it's also high risk. They are navigating very real operational and financial challenges on that road to sustainable profitability. It's typical of emerging tech disruptors, but the hurdles are significant.
It really is that classic innovator's journey, isn't it? You've got the huge potential of technology, the market disruption, but balance against the serious costs, the capital needed, the execution risks of actually getting there. They have clear vision in vital sectors, but also undeniable financial headwinds right now. So here's a final thought for you to chew on. How do you evaluate a company like Ondas, where the vision, the tech promise, it's all very compelling, the growth is explosive, but that path to actually making consistent profit is still, well, a significant hurdle. What factors weigh heaviest for you in that kind of scenario when you're thinking about long-term viability and potential? How do you balance today's financial reality against tomorrow's technological impact? Something to consider.